Good afternoon, everyone. This is Brian Shannon from AlphaTrends.net. Today is April 5th. It is a Friday, and the markets are closed for the week, and we had a pretty volatile week. Let's take a look at the numbers here. The S&P 500 for the week did lose just a little bit less than 1%. The Russell 2000 broke that important support at 93 that we've been watching and was down 2.8%. And semiconductors are really faring the worst here, down 3.6%. The bonds, by the way, went positive for the first time this year on a percentage basis, for the first time in a while. We'll take a look at that chart also. But let's take a look at the action because we had a big gap lower this morning, but it did hold. The low today was 153.77. We were talking about an important level down at 153.50 for this market, and we do have a rising 50-day moving average still in the S&P 500. So the uptrend remains intact overall on the daily picture for the S&P 500. That's not the case for all these markets, and we did see reason for concern earlier in the week as we got below that first level of support we were watching at 155.80. Once we broke below that, we were also below the 5-day moving average, and we held resistance at that 5-day moving average. So obviously today we had the jobs number, the market gap down significantly, but it's good to see that the buyers were in control pretty much the entire session here as it closed right up near the high for the day, although obviously still down on the day and down on the week. It looks like this market will probably need some time to still correct here. I don't think that just because we turned around here we're out of the woods. We are below a declining 5-day moving average, and we have a pattern right now in this intermediate term time frame that's been interrupted. That is, this little pattern of higher highs and higher lows is now turned into a pattern of lower highs and lower lows. So what we'll look for is, in order for us to trust this market from an intermediate term standpoint once again, we'll need to see this market get back probably above about 156. That's going to be the important level we stay focused on next week. If we can close above there, then we would turn a little bit more neutral towards the near term, but it still is within reason to think that we might get a test of the 50-day moving average here in the next week or two, and just continue to express a little bit of caution as we've had a great run, and this market needs to digest the rally either in terms of a price pullback or in a time correction, which could lead us down again towards, if we break the 153.50, I think there'll be a little bit of panic, and we have that 50-day moving average at 153.16. Certainly a little undercut at that level would be not a horrible thing. If we take a look at the volume weighted average price year to date, you can see that's down at 151.60. Maybe we'll go test that at some point, but right now the outlook for next week is we're going to remain near-term cautious as long as the market is below 156 on the S&P 500. For the Nasdaq, we did break below. We first got kind of a volatile week here. Let's take a look at actually this chart with only the volume weighted average price for the year, that is year to date. You can see what a choppy market we've been in, and it continues to be the case. Let's take a look at the chart the way we're used to looking at it with these moving averages. That's a 50-day moving average. We closed just below it. 67.86 is the 87 is the 50-day moving average. So we closed a penny below it. It is still advancing, so generally we want to give it the benefit of the doubt. However, it's just been grinding higher this year. It really hasn't had any of those nice spurts. We had this little shakeout over here. We had what looked like another shakeout, and it's been quite volatile for the Nasdaq. We were looking at, I think on Monday, we saw the break beyond 69. I wanted to see a pullback and then a push higher. Instead, we saw it break down, and our key level that we were keeping an eye on, that 68.25 to 68.50. We closed right in there. We had a declining 5-day moving average that put us on caution, and now we're going to need to see this market get back above 68.50 next week in order for this market to kind of be trusted once again. The Russell 2000 really again was where we saw the early damage, and where we've been watching this market and saying innocent till proven guilty as long as 93 held. 93 broke earlier in the week. We then saw it rally up and find resistance. resistance at what's been an important level in here. So this has been the band of support. We found resistance at the top end of that where the 5-day moving average was and continued lower. As I pointed out on StockTwits, I think on Wednesday, that we were approaching the volume weighted average price year to date, which is right down here at about 90.68. We were also at, I've got this drawn in already, the 50% retracement of the yearly range and that trend line. So we found a little bit of support in that area today as the market obviously gapped significantly lower in a pretty impressive rally back up. Now we're going to want to see that 92 is our first level, and then of course 93 is the bigger level that has the potential to act as resistance. So I think that maybe we get a little rally up towards 92, pull back, and then break beyond it, and then we'll see how this market responds. If it can rally back up towards 92 to 92, 93 to 93 and a quarter, will this prior important level now act as resistance? We have a declining 10 and 20-day moving average. The 50 is still advancing, so we've got mixed messages, and I think it's just prudent to look at this market and say we need to let it settle down and give us some more answers. Again, it doesn't need to end badly. The market broadcast clearly that there was some weakness to be dealt with as the Russell 2000 broke below that 93 level. Now the semiconductors have been really a little bit more troublesome, and you can see they broke below an important level that we've been watching, which is $34.30. It's 34.30 up to 34.50. I think is our important level. Now I'd mentioned last week the potential for this head and shoulders pattern. It was early to talk about it, but now it looks like we have that in place here, and we could see the market continue down towards 33. However, first I think what we want to look at and monitor in here is, will this prior support area now act as resistance? We're going to have to see this market close back above about 34.60 to really have any feeling that maybe this is just a shakeout. So for now, be very defensive in terms of the semiconductors. Perhaps we get back up into that area, but we're now below a declining 10 and 20-day moving average. The 50-day moving average is flattened out, so I don't expect a lot from that group. By the way, take a look at Alpha Trends. If you're viewing this on YouTube, I've got a new site up at alphatrends.net, and I'm pretty excited about the new product offerings that are available there. It's a little bit broader range of what's available in terms of subscriptions, so hopefully there's something there that can help you with your trading. The financials did break below that 1805 level, and we were talking about 1805 being an important level, that if it broke below that area, perhaps we would see a test of the rising 50-day moving average. Well, we came down below that 50-day moving average, which is now at 1786. We saw a low today of 1777, but you can see it was met with buyers. So people who sold short on that 1805 breakdown really didn't make much progress this week. It's easy to look at and say, well, it's overbought and this sort of thing. But we got down, broke that trend line, broke the 50-day moving average, but it didn't lead to a catastrophic failure. And typically, when we have a rising 50-day moving average, it will not lead to a bigger breakdown. We're going to need some time to distribute if it's going to lead to a bigger breakdown, but there's certainly need to be caution here until we can get back above still this 1830 level. We were talking about 1805 to 1830 being the important area that if we broke down, we'd probably see a test of the 50. We saw that. Now that that move's been made, we need to give it a little bit of time and see how it sets up from here. Interestingly, the commercial real estate index closed at a new high here today for the week, for the month, and for the last several years as well. I'm not sure exactly what to read into that, but gold had a bounce today within this downtrend. Last week we were talking about the possibility and the likelihood that it would get down towards this 148-ish area. I still think it's likely to get down there. Now we're going to get, we're seeing a little bit of a bounce, but we're clearly still in a downtrend, and we broke that support. The people who bought because of a so-called flight to safety on Cyprus, again, the trend is much more important than one or two little news items. And I don't mean to trivialize Cyprus or any other global concerns, what's going on in North Korea and that sort of thing. But clearly there are still sellers in gold, and you can argue all you want with the logic of it, but the market is always correct. And right now we continue to be in a downtrend. to begin the stabilization process, we're going to need to see it back above 155. But with a declining 50-day moving average, do not trust this to the long side. Let's take a look at bonds. This is pretty interesting too. For the year, the bonds are actually up. As I had mentioned, we closed the year out right over here, and now this is a composite of the 20-year blended treasuries, the TLT, and it again shows the danger of listening to conventional wisdom and all of the arguments that were at the beginning of the year saying that the bonds are dead money and that yields will definitely be rising. Well, we've got yields at the low for the year right now, and it shows again that news helps shape the opinion of the market, and there are obviously things we need to be aware of, but be more aware of what is the direction of the market, what is the trend, who's in control, what are the bigger levels of support and resistance. If you approach the market with a consistent discipline, it's going to allow you to be much saner and not chase things up and down all over the place. Instead, be aware of the key levels of support and resistance, know what the direction of short-term moving averages are, or whatever the time frame it is that you're most comfortable with in the market, and implement that plan with discipline and consistency. And these gyrations will affect you from time to time, of course, but you can be prepared and often sidestep some damaging moves and have your money available for when the market makes it a little bit more clearer and the setups are just a little bit easier. So again, take a look at alphatrends.net. Thanks for listening, and I'll talk to you next week. Have a good weekend.